But right now, talk about matching liabilities and assets. Well, you just take that bloody 25-year Treasury or 30-year Treasury, which is today yielding 2.5%, and I think you're bankrupt, actually, if you use that to match, because the government bond yields have gone like this, even as the corporate bond yields have gone like that. So we've never, talking to my friend, our honored guest, former Senator Peter Fitzgerald today, about this at lunch today, we've never had a spread like that between government bonds and corporate bonds. So that should make corporate bonds attractive, unless they default at a rate of over 4.5% a year, which is the spread. So we don't know so much. So I think it's a question really of diversification and trying to somehow give people the idea when stock prices are high or low, knowing that that's merely a guess. And I'll just add one little thing to tell you how much of a guess. I've been using this little formula of mine, investment return, dividend yield plus earnings growth, and speculative return, and I first used it in 1990. And I predicted that the stock market's return in the 1990s would be, I think it was 9%. Well, the stock market return in the 1990s was 17%. Pithy. But by 2003, it was, guess what, 9% from the beginning of the period. So that we really do know what's going to happen, I think, more than we give ourselves credit for, even as we do not have a clue, not a hint, as to when it's going to happen. And that's the problem with risk. It's always there, and sometimes it manifests itself, and sometimes it doesn't.
One more question. There was a hand up in the back, I believe. No? All right, here's one, yes. Could you go to a microphone? Well, this is being taped.
Orders are orders. No, only kidding.
Rahm Emanuel is taping it.
Rich Verlado from the AFSCME and AFSCME Pension Fund. Just a couple of reactions to Mr. Bogle. First of all, about the issue of pension fund use. Much of Jack Welch's almost $1 billion payday over the tenure of his position as CEO at GE was actually driven by earnings during the bull market on his pension system. Interesting to note. Also interesting to note, State Street has just filed a no-action request against a shareholder proposal that was filed there, claiming that it was against their fiduciary duty to have a long-term outlook when it was voting their proxy, various shareholder proxy questions, because it was against the new DOL ERISA regulations that were just put out in the dying days of the Bush administration. Third, Vanguard and AFSCME and a number of other organizations, including the Corporate Library, have been working with the new mutual fund disclosures regarding their proxy voting. And we find that, unfortunately, it's the index funds, particularly State Street and Vanguard, have been absolutely the worst in voting for shareholder proposals and other questions, particularly regarding trying to make executive compensation much more performance-based. So that there's a lot of work to do with these index funds that have sought to drive down the cost of delivering their service, as you rightly say they should, but then accepting no responsibility at all to analyzing the internal governance structures to make sure that the companies are operated in the best possible way to achieve long-term value. All of that sort of comes together to say that the institutional investors that we work with very closely, primarily the public pension funds, have got a great interest in working to organize retail investors who are also their members, because we can't achieve corporate change just with the assets of the public institutions. But if we worked with our members who are also in the 401k and the 401k and the mutual fund world, I think we've got a fighting chance. So that there's a lot of interest in that regard, and we've actually have a lot of thoughts in that area.
Great question.
Well, let me say a couple of things. One is the fact that the main thing is to start getting these institutions to vote. And if they vote in a way that doesn't comport with your particular position, I'm not sure that's maybe the position isn't quite as soundly drawn as it should be, or whatever the case might be. I don't think agreement is necessary. necessarily the best test. I think it's participation, and that participation has come way up. From what I read, nothing to do with Vanguard's management, but we are one of the more active voters. But most of the big firms are active too, since we had to disclose the votes. Although no one has come to where TIAA-CREF is in terms of really corporate activism, and I think that has, sad to relate, a very simple rationale, and that is TIAA-CREF does not run giant 401k and pension plan accounts, and we do. So, everybody says it doesn't matter. We don't care. We don't mind offending management. The record is not clear that's correct. Although the record is quite clear, based on academic studies, that mutual funds, whether they run these pension assets or not, are basically reluctant. They vote pretty much for management, whether they're running big pension plans or not. So whether that's definitive or so, I mean, you can't do a statistical test that says if IBM is a big client, which happens to be for Vanguard, that Vanguard's behavior with IBM proxy is any different from the market's behavior. So I'll wrap this up with one more little anecdotal story, which I think will explain this to you. I talked a lot about corporate governance and participation, and I always thought that indexers were the ultimate long-term investors. They don't trade stocks. They hold them forever. As long as the company exists, it's in the index, one way or the other. So I tried to, in a speech, I mentioned that we ought to have a council of long-term investors, get rid of all the speculators in the fund business. And I could find about 12 mutual fund companies that I thought met that test. So I said, why don't we all get together? And so we did, or at least some of us did. We met in New York. And the big indexers all came, not Vanguard. That's another story. But we sat down and talked about it. 2 or 3 of the long-term investors, some of them had legitimate reasons they couldn't come. And some of them said, I just don't want to raise my head on this one. It might get shot off, but keep me informed about what's going on. And at the conclusion of the meeting, we were talking about more active voting from particularly index funds, but also any other long-term funds you can find out there, not numerous in quantity. And he said, Jack, I see what you're saying, but why don't we just leave it to Adam Smith's invisible hand? And I said, for God's sake, don't you know that we are Adam Smith's invisible hand? And that was that. We'd ever have another meeting.
Well, that's a great note to end on. We are Adam Smith's hand. And let's take ourselves by the hand and go back into the other room. And please stay for panel 3. Thank you.
Yes, then it came back.